Our view on the ECB's decision is, I think the rate cut was very clearly signaled and expected. The question now is this the beginning of a continued trend of rate cuts? And we do think that despite Christine Lagarde saying the decisions would be data dependent, and I can't think of a single central banker who hasn't said the decisions will be data dependent. But we think that the data warrants further rate cuts between now and the end of the year, and indeed continued rate cuts on through 2025. As you mentioned, the forecasts for growth were cut. But even if we compare our own forecasts with the ECB forecasts for 2025, we think that the growth outlook is probably going to be a little bit worse next year than the ECB is expecting. So that means that there's room to cut interest rates and a need to cut interest rates in October and again in December. So we think that there's going to be continued rate cuts, and that will support European assets, both equities and debt, going forward.
What about the rate differential between the ECB as well as the Fed, rates in Europe versus in the US? Because I think now with this rate cut, the ECB is front-running the Fed by 50 basis points. And so is that gap sustainable?
Well, I think that the Fed is just getting started. So the Fed is going to cut interest rates as well. Again, we think that there'll probably be another 3 rate cuts by the US between now and the end of the year. So probably the short-term interest rate differential will be fairly unchanged. The big difference, actually, in terms of what's gone on in the past 3 to 4 months has been at the long end, where US Treasuries have rallied much more than the European market as the US has slowed. Now the US has slowed, but Europe has also slowed. And we actually think that that interest rate differential can widen out a bit, with European bond yields falling faster than US bond yields between now and the end of the year.
Yeah, and that's an interesting point that you make. Why is it that there's not that much demand for European bonds? Is it because of the underlying economic conditions? I mean, we're talking about how developed Europe, Northern Europe, is actually underperforming Southern Europe.
Well, I wouldn't put it quite as the case of not so much demand for European bonds. I think there's demand for fixed income everywhere in the world, both in terms of the US and Europe. Mostly what's happened is that the US has rallied faster than Europe. So I would say that on a relative sort of valuation basis, Europe is looking better. I mean, demand for fixed income comes when the economy is slowing and people think that real rates will actually decline. And as we've talked about, the European economy is going to be a little bit stronger in 2025 than this year, but not very strong. So that still justifies further interest rate cuts, and that justifies a downward translation of the European yield curve.